Hello, good morning.
Hi, my name is Doug Carroll, and it'll be my pleasure today to present to you the first of 4 sessions on derivatives. Subsequent sessions will focus on specific segments of the derivatives market, but today's session will be an overview. The intent is to provide a clear distinction, the intent of today's session is to provide a clear distinction between derivatives and other sorts of financial instruments, as well as to provide a clear understanding of exactly what derivative contracts are. All too often, derivatives are defined as financial instruments that derive their value from something else, and that definition is so vacuous as to be completely uninformative, and indeed is downright misleading if one were to interpret the words too literally. But we'll get into the specifics of the implications of those statements over the course of our time together. So let's begin by considering what are the primary types of derivative contracts and what distinguishes the one group from the other. Because boiled down to their bare essentials, there are really only 2 types of derivative contracts. Oh yes, there are literally hundreds, if not thousands, of variations, but boiled down to their essentials, there's really only 2 characteristic types. Although, as we'll see further into the series of presentations, some derivative contracts are actually combinations of the 2. But boiled down to their very bare essentials, all derivative contracts could be categorized as either forward commitment contracts or contingent claims. Now, as noted on slide 2, the forward commitment contracts are made up of futures and forwards contracts, as well as the forward commitment swaps. And as indicated on the slide, that includes interest rate, currency, properly cross-currency, although most people refer to them as currency swaps, commodity and equity swaps. Contingent claims, on the other hand, are all options from the simplest, most basic plain vanilla put or call to the most obscenely complex exotic option, maybe some sort of double barrier knock-in or knockout, as well as credit default swaps. So a couple of qualifying comments before proceeding further. Please understand that any comment I make during the course of this presentation, unless otherwise qualified, is presumed to apply only to plain vanilla puts and calls. If I were to try to make my statements so general as to be correct for all sorts of options, including the exotics, the statements would have to be so general and vague as to be completely uninformative. So presume, as I indicated before, I'm only directing my comments relating to options towards simple calls and puts. And aside from all options, the other category of contingent claim is credit default swaps. So even though credit default swaps, or CDS as they are often called, have a word in the name common with the 4 forward commitment swaps introduced earlier, the nature of credit default swaps, or CDS, is completely different from all of the other derivative contracts that are also referred to as swaps. Now, what are the key distinguishing characteristics between these 2 major categories? Well, in the case of credit default swaps, excuse me, In the case of let's go back to forward commitment contracts. In the case of forward commitment contracts, the key word is commitment. Now, we'll get into the details later, but for the moment, realize that in all forward commitment contracts, both counterparties are incurring a legal commitment, a financial obligation to do something at a later date. The key word in the other descriptor of contingent claims is contingent. In other words, something may or may not happen under the terms of the contract. And please understand that these words are, or these categories are way beyond just some academic classification. Because if one has a general understanding of the characteristics of the two categories, it goes a long way towards providing a basis for understanding the pricing and valuation of the two. And so consequently, some insight into how they're likely to be used and the consequences for the sorts of market exposures that are created by using either of the two types. So let's consider in a little bit of detail the characteristics of the two categories. So as noted, with the forward commitment contracts, no matter which of the various types introduced on the previous page, all of them entail both counterparties to the contract incurring a legal obligation, a contractual commitment to do something. Now, in subsequent sessions, we'll go into the details of the nature of those contractual obligations at more length, but just to make the point to establish some basis for the conclusions I'm about to draw, a couple of examples are illustrated on slide 3. So consider a futures or forward contract that has a delivery feature. Not all do, many are cash settled only, as we'll see in the next session, but the basic type has a delivery feature. So what's being exchanged between the buyer and seller, the long and short that are the counterparties to the futures or forward contract? Well, the short incurs the obligation to make delivery. The long incurs the obligation to take delivery. So those are the contractual commitments the two are exchanging. Or just to broaden the illustration, consider the elements of a plain vanilla interest rate swap, which will be one of the contracts focused on in the third session in the series. Well, in the plain vanilla fixed for floating interest rate swap, one party is committing to paying a fixed rate of interest to the other. The other party is committed to paying a floating rate of interest. So in all forward commitment contracts, futures, forwards, and swaps other than CDS, the counterparties are exchanging legal obligations. Now, as noted in the bottom portion of slide 3, what are the implications for the pricing or valuation? Well, in the vast majority of these contracts, they're entered into at fair value, commonly referred to as at market, or in the current parlance of the interest rate swap business. This is what would be referred to as a par swap, par interest rate swap. By definition, all futures contracts are entered into at fair value, and the vast majority of swaps and forward contracts are also entered into at fair value. And we'll see the implications of that later on in this session when we look at the standard arbitrage pricing model. Well, if such contracts are entered into at fair value, that means the counterparties are exchanging equal but opposite obligations. And think about the implications of two counterparties to a contract exchanging equal but opposite obligations. Which party has an advantage in that case? Well, of course, if counterparties are exchanging equal but opposite obligations, neither party has an initial advantage. In other words, the initial value of the contract is zero. Now, for people not familiar with the markets, that might sound like something of a sort of a theoretical or academic curiosity. Who cares that the initial value is zero? Well, think about the implications of that for the cost of taking such a position. That means that entering into a forward commitment contract at fair value has no cost whatsoever. Now, what are the implications of that? Well, consider the exposures and the cost of creating exposures in financial markets. Now we'll look at exposure profiles in the next couple of slides, but to focus on the word exposure for the moment, because I will use that as shorthand for a much bigger idea. In the context of our presentations, exposure means one has a position in the market. And of course, when one has a position in a financial market, that means there's capital at risk. And once having created an exposure, that means that to the extent the market moves in your favor, you're generating a gain. To the extent the market moves against you, you're suffering a loss. Now, usually market moving means up or down, but many derivatives pay off under much more complex circumstances if values end up outside of a given range or within a given range. But without getting into the details of particular exposures at the moment, the general idea is that with exposure comes potential for gains or losses depending on how the market moves once the position or the exposure is created. We'll consider what it takes to create $10 million worth of exposure in, say, the US Treasury market. Well, it's going to take you $10 million. You either have to have accumulated $10 million or convince someone to lend you $10 million to buy $10 million worth of Treasury securities. What about creating equivalent exposure in something like futures? And the same idea applies with swaps, although it's less defined, as we'll see. But to establish a position in derivatives generally requires only posting margin or collateral. Margin is the word used in the futures business generally, collateral in forwards and swaps. But in both cases, the idea is the same. One is putting up a performance bond or a good faith deposit. More about that in subsequent sessions. But as an example, to establish $10 million worth of exposure in US Treasury futures might only require me to post $200,000 of value. I'm not paying that to anyone else. I simply have to deposit that much value in cash or collateral value of securities in my futures account. And I can put up interest-bearing assets such as T-bills or corporate bonds, which means not only am I not paying anybody anything, but I can post assets upon which I'm still collecting the interest income. That's why I'm saying such positions have no cost whatsoever. Think of the capital efficiency that implies in terms of how much exposure one can create without incurring any cost, at least to establish the position. Now, that capital efficiency is a double-edged sword because it's another way of saying one can create a lot of leverage with much greater ease in derivatives than is the case in securities. And so if I only have to put up margin or collateral equal to 2% of the value of my position, well, of course, that means if the market moves 2% in my favor, I've doubled my money. On the other hand, if the market moves 2% against me, I'm wiped out. So this magnification of the amount of exposure relative to capital is not an unmitigated good. It's a double-edged sword, as is always the case with leverage. What about the characteristics of contingent claims? And we'll use a plain vanilla call option as the way of illustrating the concept. So one has with an option contract, one acquires the right but no obligation to do something. With a call, one has the right to buy. With a put, one has the right to sell. At least that is true for the owner of such contracts. But note that if I have the right to buy, if I exercise my right to buy, there has to be someone on the other side of the contract that is selling me what I have the right to buy in the case of a call. Well, note the inherently unequal contractual relationship between the long, the short, and option. One has the right but no obligation. The other has an obligation to meet the terms of the contract if they get an exercise notice. Now, why would one ever enter into such a contract? Well, unlike the forward commitment contracts where there is no cost to either take a long or short position if done at market, options should always have a cost imposed on the buyer. Now, this is a perfect point to illustrate what I meant about making comments only directed towards plain vanilla puts or calls, because there are types of exotic options which have no cost to enter into them. The type of exotic known as a deferred premium option, where one only has to pay the premium if they decide to exercise. But going back to the plain vanilla options, think about the circumstances illustrated at the bottom of slide 4. In the spring of 2000, and that it says 2017, should say 2016. In the spring of 2016, Google was trading at about 630, and had earlier in the season traded much higher, close to $700 a share. Currently, by the way, Google is over 900. So I say this example is from a little bit over a year ago. But there are weekly series of expiring options. And so the week Google was announcing earnings, there was a series of 660 calls. That's the strike price at which the owner of the call had the right to buy. And with Google at only 630, the right to buy at 660 isn't very valuable. Such options were trading at about 25 cents a share. And given the contracts were for 100 shares each, that's $250 a contract. Now, options on most stocks would have been trading at a penny or two, but people realize Google can occasionally move very significantly, especially after a market moving event like an earnings beat or miss. Well, that week it turns out Google announced earnings that amounted to an upside surprise, and within minutes of the earnings being announced in the aftermarket, in other words, shortly after market closed, Google traded up to $6.75 a share. In other words, the contracts that had been trading at 25 cents per share were now trading at $15 or more per share. So for investing $250, one could have made $1,500 per contract. Point being that because the party buying the option acquires the right without an obligation, the implication is that they should always have a cost to the buyer, because even an option way out of the money and very close to expiration might still turn out to be ultimately very valuable, as was the case in this Google example. Slide 5 just shows a bunch of exposure profiles, which I'll not linger on at the moment, but note the middle panel is labeled long underlying, underlying being derivatives market phraseology that is a way of referring to the related security or commodity that will have an impact on the value of the derivative. And you'll note that the long underlying slash futures or the short underlying slash futures, and by the way, this would apply to all forward commitment contracts, as we'll see on a subsequent slide. They imply symmetric gain-loss profiles. The farther the market moves in your favor, the bigger the gain, but the farther the market moves against you, the bigger the loss. With the contingent claims, the four corners are labeled long and short call and long and short put. Note that on one side of the crosshatch, and maybe I should describe the diagrams in just a little bit of detail for those not familiar with them to make it easier for them to follow. We're measuring gains and losses by the vertical displacement from the horizontal axis. So gains would be indicated by movement above the horizontal axis, losses by movements below. And those gains and losses are driven by changes in the price of what the middle panels refer to the underlying security or commodity or financial instrument. The movements to the right indicating an increasing price of the related asset, movements to the left indicating a decreasing price of the related asset. Well, note that for all of the contingent claim diagrams in the slide, they are asymmetric gain-loss profiles. The crosshatch in these diagrams indicates the strike price of the strike or exercise price of the option. And you'll note that on one side of the strike price in all the diagrams, there is a range of prices over which the counterparties to the contract are suffering or realizing increasing gains or losses. That's the in-the-money side of the contract. On the other side of the strike price, there's a range of prices of the related security or commodity that result in no change of the outcome. A consistent gain to the seller or short, a consistent loss to the buyer or owner of the contract. That occurs when the option's out of the money. Owner won't exercise it, so they lose the cost of the option, the premium, and the writer will realize as a profit the amount of the premium received for selling the option. But I don't mean to linger on these diagrams for the moment. The idea is mostly that we wanted to give you a general sense of what we'll be talking about in the subsequent slides and future sessions as well. So let's consider in just a little bit of detail some of the implications of the contracts. Here you see a magnification of the left-hand middle panel on the previous slide, and you'll note the more detailed heading here. So this would be the implication of what if one was long the underlying security or commodity, or long the related futures or forward contract on that security or commodity, or the total return receiver on a total return swap like an equity swap, or for that matter the fixed rate payer on a fixed for floating interest rate swap. Now this is simply a magnification, so this is no new information. This diagram is showing that should the price of the related security or commodity increase, the bigger the increase in the value of the underlying or related asset, security, or commodity, the bigger the gain to the long. Conversely, the bigger the decline in the value, or the larger the decline in the value of the related asset or security or commodity, the larger the loss. So this is just expanding what was discussed in the previous slide. Now, for one not familiar with these sorts of contracts, one might wonder, what's the need for having a derivative contract that generates the same gain-loss profile as if I was long the related security or commodity? It goes back to the capital efficiency we talked about previously. But what is one of the other implications of using such contracts for, say, risk management or hedging purposes? Now this slide is simply a greater detailing of what was discussed previously, the capital efficiency, and also, as we'll touch on later, some additional considerations why one might use derivatives rather than securities or commodities. But I don't want to focus on the additional considerations now. We'll touch on these again later at the end of the session. But consider the exposure profile created by selling or shorting, or being the total return payer, or the fixed interest rate receiver on a fixed for floating interest rate swap. Well, one creates the equivalent of being short the underlying security or commodity. Well, consider briefly a risk management application with such contracts. Let's say I was long an equity security like Google stock, or long the S&P 500. That creates the exposure profile of a long position. If I say wanted to hedge that long exposure, and one might say, well, why not just sell? Well, selling securities could generate a capital gains tax consequence if I was long, and especially if I only had a temporarily negative view on the market. Just thought that Trump might speak and the markets might go haywire. But long term, I like the prospects for the American economy. So I decided to hedge my long exposure in securities by shorting the related futures or forward contract. So long the S&P stocks and short S&P futures, for instance. Well, if as anticipated the market were to decline, or if as feared perchance, I will not suffer a loss in the overall value of my hedged position, because the decline in the value of the securities should be offset by a gain in the value of the derivative. Now, this diagram is, of course, very simplistic because it's just trying to get at the general point of the situation. Because the implications of the diagram, well, are several. Given that I've got both the long and the short exposure crossing the horizontal axis at the same point, that implies the futures price is the same as the market value of the underlying. As we'll see when we talk about forward pricing in the next session, typically the derivative would not be priced at exactly the same as the value of the underlying. It has to do with cost of carry pricing, and we'll get into those issues in the subsequent session. Also, by implication, the decline in value in both markets was exactly the same. That's why the gain on the short futures is exactly the same as the loss on the long equity position. While a fairly priced futures or forward contract will move almost exactly the same as the value of the underlying, at least over a short period of time, there's no guarantee the price moves would be exactly the same. But they should be similar, but again, issues we'll talk about in more detail later. The purpose of this exhibit is simply to convey the concept of hedging. But one important point to realize, and this relates to the symmetric gain-loss profile of all forward commitment positions when talking about the exposures created by using a forward commitment derivative. Properly structuring a hedge with a forward commitment derivative means that should the market move against your original position, as in this example, the loss in the value of the related securities or commodities would almost be completely offset by a gain in the value of the derivative. But what happens if the market were to have moved in favor of your original position while it's hedged? Well, in effect, one flattens the exposure by fully hedging a position with a forward commitment derivative. And that means that no matter how far the market moves up or down, there should be very little change in the value of one's position. Well, that's good if the market moves against your original position, because now the decline in the value of your securities or commodities would be completely offset by a gain in the value of the derivative. That was slide 9. But note on slide 10, in this case, we're looking at a situation where the market moved in favor of the original position. Well, unfortunately, if hedged, one will not benefit, because if one fully hedges their exposure with use of a forward commitment derivative, as the market value of the related security or commodity rises, yes, there'll be a gain in the value of the original position. That will be almost completely offset by a loss in the value of the derivatives used to hedge that exposure. Now, this is assuming, again, fairly priced derivatives, but the point being, in general, when one hedges with forward commitment derivatives, given the symmetric nature of the exposure created by the derivative, that's going to near completely offset the change in the value of the related securities or commodities. So it's a very inexpensive hedging vehicle, but it takes away the potential of realizing a gain had the market moved in favor of the original position if it's been completely hedged by use of a forward commitment derivative. Let's consider briefly an implication of a contingent claim. And in fact, let me jump out of presentation mode for a moment so we can look at both the related words on slide 11 and the exposure profile on slide 12. Because note on slide 12, the exposure profile created by a long call. What implies that once I'm in the long call position, should the market value of the underlying decline, I'll not suffer an increasing loss. My loss would never be greater than the premium paid to buy the option, no matter how far the market moved below the value of the strike price of the option, as long as I act rationally and don't exercise an out-of-the-money option. On the other hand, should the market value of the underlying rise, the greater the increase in the value of the underlying, the bigger the gain on my long call position. Now, could I create an exposure profile similar to that by trading the underlying security or commodity directly? Well, I could attempt to. The question is, could I effectively achieve that outcome? For instance, as noted in slide 11 under the trading the underlying description there, I can take a long exposure by buying a stock or the ETF on the S&P 500 if I want exposure to a bunch of stocks at a single transaction, the so-called SPDRs, Standard & Poor's Depository Receipts. And once I place that order to buy, I can actively monitor my position. And I could have in mind some maximum loss with the intention to enter an order to sell as soon as the market declines to the point where I want to limit my loss. Well, that raises a number of issues, of course. Do I have the flexibility to monitor the market continuously? Because if I can't, the market might move when I'm not watching, and loss could be much greater than anticipated. But even if I can monitor the market continuously, with the intent of entering an order to liquidate my long position as soon as the market drops below the specified point, and I want to limit my losses to that amount and no more, well, even entering the order at exactly the right time doesn't guarantee an execution price at a level that will limit my losses to the desired amount. Markets sometimes gap up, or in this case, gap down, and market moving news could cause the price of the related securities or commodities to drop way below the level where I intended to limit my losses to. Now you might say, but one could enter a sell stop or a stop loss order to limit my losses to no more than the stop price indicated on that resting order. Well, the problem is, of course, that even the broker or the execution system that's holding that stop loss or sell stop order, they can only try to execute it once the market hits or goes below the specified stop price. And again, if markets gap down so that the first trades at or below my stop price are well below the prices where I hope to exit my position, my losses will not be limited to the intended amounts. On the other hand, if I buy a call option and, as I indicated earlier, act rationally and don't exercise an out-of-the-money option, well, that means my losses will never be greater than the intended amounts, which means, as indicated on slide 12, that I can know precisely what my losses are to the downside with an option in a way that is almost unattainable by actively trading a long position in securities or commodities. Let me go back to presentation mode now. So let's consider the details on derivatives that make them distinct from other financial instruments like securities. And in fact, I'm going to go back to my being out of presentation mode because, again, I'd like to look at a couple of slides. Consider slide 13 and 14 simultaneously. And the words are on slide 12, but I like to have the visuals that are, excuse me, the words are on slide 13, but I want to focus on the visual in slide 14 to try to make the point. What's characteristic of all derivatives? Well, in all derivative contracts, there is someone who's long and someone who's short. Now, the specific terminology varies depending on the type of derivative you're talking about. It could be the credit protection buyer and the credit protection seller. It could be the fixed rate payer and the fixed rate receiver. It could be simply called buyer and seller or long or short, but without delving into the details, which will be focused on at length in the subsequent sessions, in simple terms, every derivative contract in existence must have two counterparties, one who's long and one who's short, or again, whatever the appropriate terminology is. Now, note I'm using in this case long and short as nouns to describe a position, not as verbs to imply an action. And long and short can be used in both fashions. Let me talk about them as verbs because that'll make another point, actually. Note with derivatives, long means to buy and short means to sell. Note what I just said. With derivative contracts, short means to sell. Contrast that with the meaning of short used as a verb in the securities markets. Shorting a security has a very specific meaning. It means you're selling something you don't own. Now, that might sound fraudulent or manipulative for those not familiar with short sales, but without delving into those issues for the moment, there are many good reasons to short securities. It might be speculating on a decline in price, but it might be hedging some other long exposure, or it's a way of fulfilling the requirements on various derivatives that might be part of a complex strategy. But without going into the ethics of short selling, the point here is that shorting a security has a very specific meaning. You're selling something you don't own for whatever reason. But shorting a derivative simply means you're selling a derivative contract. So for example, I worked briefly in the T-bond futures pit several decades ago. Overhearing a trader walking out of the T-bond futures pit saying they just shorted 100 futures contracts would tell you nothing about their existing position. It would simply be informing you that the trader had sold 100 contracts. Now, of course, if a trader had no position whatsoever and shorted 100 December T-bond futures contracts, that would have created a short position of 100 contracts. But if they had been net long 500 contracts previously and then shorted 100, they'd still be long net 400 contracts. So that's long and short as verbs. Let's go back to long and short as nouns. Again, all derivative contracts have two counterparties, one of whom is long and the other who is short, or again, the terminology varies from derivative type to derivative type. But think of the implications of there being someone who's long and short every contract in existence. That means the number of long positions must be exactly equal to the number of short positions. Now, there's a more precise rendering. I should properly say it as the gross size of all long positions equals the gross size of all short positions. So I'll shorthand that by simply saying equal number of long and short positions, despite the fact that that's taking a little bit of liberty with the English language. But the implications of there being an equal number of long and short positions means that all derivative markets are zero-sum games. And of course, a zero-sum game is a situation where the gains to the winners are exactly equal to the losses of the losers. Implications of that? Well, let's use again the T-bond futures market as an example. What happens if T-bond futures prices are going up? Longs are winning and shorts are losing, of course. And that means, given the daily settlement based on that day's price change, the so-called mark-to-market, which we'll talk about in the next session, based on the increase in the value of their positions, money is being added to the account of all of those traders with long T-bond futures positions. But where's the money coming from to cover those gains? Well, of course, it's coming right out of the accounts of the shorts on the other side of those positions. So I use T-bond futures as an example, but this is true for every type of derivative contract across the board, given that for every contract in existence, there's got to be someone who's long and someone who's short. That means there are an equal number of long and short positions, and again, that's shorthand terminology. But that means that by the nature of those markets, the derivative markets in every segment always work out to zero-sum games. Now, we'll come back to the implications of that in a minute, but let's contrast that with securities and a common confusion, because all too often people interpret equal number of long and short positions to mean an equal number of buyers and sellers. Those are two different perspectives on the market. Of course, for a trade to take place, there has to be both a buyer and seller, otherwise the trade doesn't occur. That's true for derivative markets, securities markets, for that matter, flea markets. It's true of all markets. Unless a buyer and seller agree to a transaction, a trade doesn't take place. But to say that for every buyer there is a seller is not the same thing as saying there's an equal number of long and short positions. Consider the diagram labeled securities. Note that all securities are created by some issuer. In this case, I have corporation, but could be a corporation, government agency, partnership. And the type of security depends on the nature of the transaction, but it could be a debt instrument. The issuer could be borrowing money by issuing bonds. Or corporations and partnerships can sell equity interests. So for corporations, those are known as stocks. But the point is, those securities represent a claim against some issuer. And given the mechanics of short selling securities, when you sell something you don't own, the buyer in the transaction is expecting to take delivery. That means you have to borrow the security you've short sold from someone willing to lend it to you. Well, again, the mechanics of short sales are a bit involved, and time doesn't permit a detailed discussion here. But given the need to cover shorts, it's unlikely in any real-world security issue the number of short positions could be even remotely close to the number of long positions. Even heavily short-sold stocks, like, say, a Netflix over the years. Just to touch on the thesis of many investors much of the time, how could a company that makes its money primarily by video streaming ever successfully compete against an Apple or a Google or an Amazon that are in both video streaming as well as have a portfolio of very profitable businesses to subsidize their streaming activities? So Netflix over time has frequently been a very heavily short-sold stock. Note, Netflix as an investment has done quite well fairly consistently, so this has not been a good investment thesis. I'm simply sharing with you it's been a common investment thesis. But even a heavily short-sold stock like Netflix, the short interest, that is the number of shares sold short as percent of all the shares outstanding, has at a maximum been 25, 30, maybe 33%. And 33 is really high, typically more like 20 to 25. So that means even for a heavily short-sold stock at times like Netflix, the ratio of long positions to short positions has been 4 or 5 to 1. And for the typical publicly traded company, it's more like 1 to 2% of the shares outstanding have been sold short. Consequently, the ratio of long to short positions is usually skewed in favor of the longs. Well, note that means if a securities market goes up or down, it's not going to be a zero-sum game. It's hard to say. We can't know in advance whether it's going to be a positive or negative sum game, because if the market goes up, the longs are winning and the shorts are losing, which means in a rising market, the gains of the longs are a big multiple of the losses of the shorts. But those losses aren't covered by taking money away from a short account. It reflects an increase in the value of the securities issued by the issuer. Interest rates are falling, meaning the present value of the future fixed coupon and principal payments are worth more as the bond market rises. Or maybe equity markets are rising because the market perceives more rapid earnings growth in the future because of a better economic environment or favorable economic policies. But securities markets don't have to be a positive sum game. That's only if markets are rising. What happens if markets are falling? Well, then it can be a hugely negative gain, because naturally as the markets are falling, the shorts are winning and the longs are losing. And of course, that means in a declining securities market, there's net wealth destruction. And just to give you a for instance, if you look at the US equity market after the bursting of the internet bubble, which was in March of 2000, well, that bear market lasted for about 2.5 years. When the market reached its nadir in October of 2002, over that cycle, there was something like $6.3 trillion of net worth destruction. That's the amount by which the losses of the longs exceeded the gains of the shorts over that approximately 30-month bear market. So, what are the key characteristics, or what's the takeaway about derivatives? Well, note the common definition of derivatives that I'd mentioned at the beginning of the session. A derivative contract is something that derives its value from something else. Now, let me state that more formally, because I don't want anyone to think that I'm overly simplifying in a way to prejudice the case. So more formally, a derivative contract is a financial instrument whose value is derived from the price of some related security or commodity. That's not a different definition. That's just a more formal statement, or maybe restatement, of the very simplistic definition I gave you a few moments earlier. And that's encapsulated, or at least the misinterpretation is sometimes encapsulated, in the two formulas shown at the bottom of slide 15. So the first of those two, that's the generic formula for pricing futures or forward contracts. And the second of those two is what's known as put-call parity. In fact, let's focus on the first of those two in some more detail. So what does that formula say? That formula says that the value of the futures or forward contract must be equal to the value of the underlying asset, related security or commodity, times 1 plus R. And note what's being shown here is the sort of generic formula one is likely to encounter in an introductory level course or text on pricing futures or forwards. And R is the symbol for interest rate, as noted below. More properly, as we'll see in the next session, that location in the formula would properly be reflective of the cost of carry, the cost of holding a position in the underlying security or commodity over the time until the delivery of the futures or forward contract. And that 1 plus R, or 1 plus the cost of carry, is raised to the teeth power. In other words, the time until the delivery of the futures or forward contract. And that is time as expressed in years, assuming the carry costs are reflected on an annualized basis, which is the common way of expressing interest rates. So that would mean a contract deliverable in 3 months, the T would be 0.25. Or a contract deliverable a 1.5 years would be a T of 1.5. Now, all too often, people looking at a formula like this will, and now I'm stealing the language of statistics, but they'll interpret the underlying price or security as the independent variable. I'm not going to try to write that out. You got the words. And the price of the derivative as the dependent variable. Now, probably many basic book writers are not even thinking that formally, but that's implicitly what they're assuming, because they're assuming that the value of the derivative is derived from the value of the related security or commodity. Well, consider what happens if we do a simple algebraic manipulation of the formula. Because you'll note, I could divide both sides of the original equation from slide 16, top line in slide 17. If I divide both sides of the equation by 1 plus r to the teeth power, or again, more properly, 1 plus the cost of carry, compounded over the time until delivery, well, now I have a common element in both the numerator and denominator on the right-hand side of the equation. And of course, they would cancel out, rendering or leaving us with the formula at the bottom of the page. Well, if the top line could be interpreted as deriving the value of the derivative given the underlying price, the bottom formula could be interpreted as deriving the value of the underlying given the derivative price. And note, both are true in an arbitrage pricing sense. If I know the value of the underlying asset and the cost of holding that position over the time to delivery, I could derive the fair value of the derivative contract. But equivalently, if I know the value of the derivative, and again, the related cost of holding a position in the underlying over the time to the delivery of that derivative, that means I could calculate the fair value of the underlying asset. So what are the implications of all that? Well, let me go back to slide 17. Think about the implications of the top line formula, the one we started out with a couple of slides previously. How should I interpret that diagram? Well, let me go back to the definition of derivatives we talked about earlier. The derivative being a financial instrument whose value is derived from the price of the related security or commodity. A literal interpretation of that definition would imply that derivative markets have to trail price action in the markets for the related security or commodity. Think about what that would mean. On the release of new information that could possibly affect equity values, say, S&P futures traders would have to sit on their hands and wait for the equity market to react first to the new information and the related repricing of equity values. And only after the S&P actual index moved first could traders in S&P futures tag along. Now, if any of you have ever seen the old video clips when most futures were traded on a trading floor in a pit or ring, well, of course, all the traders are jumping and screaming and gesticulating wildly, trying to buy or sell or both simultaneously anytime market moving news hit the tapes. They weren't waiting for any other market to move first. Well, that's because all markets are in the business of price discovery. And without going into it in detail, as time doesn't permit, price discovery simply means that traders and markets are reacting to information to try to move value to the right level. That's true in a securities market or a derivative market. And you know, just to give you some basis for that statement, naturally market participants would rather make money than lose money. Oh, I can state that more formally, of course. Market participants are trying to maximize their risk-adjusted return on capital within some specified risk constraints. But that's just a highfalutin way of saying they'd rather make money than lose money. What's going to make it that will be the likely outcome of your trading activities? Well, of course, making good buy and sell decisions. And that means likely doing a lot of research. Now, the research might be fundamental, where you're looking at company annual reports, government economic releases, industry projections for sales and profits. Or it might be technical analysis, where you're looking at financial market generated statistics, advances versus declines, new highs versus new lows, support and resistance areas. Or quantitative analysis. And it's more complicated in this, of course, but in general, quantitative analysts are using data, often the same data that's being used by the fundamental analysts, But where fundamental analysts are trying to look through the data to understand the underlying business reality, quantitative analysts are looking for patterns in the data. So all market participants are engaging in one or possibly, in fact, most likely several of those different types of analysis and using that to inform their buy and sell decisions. But that means as market participants are acting on the fruits of their research to buy or sell, increase or lighten some position, hedge or unhedge some position, that means the fruits of their research, the information they're gleaning from their research, is getting reflected in price. It's true, that's price discovery. Right? So price discovery takes place in all markets. Derivative markets, security markets, flea markets. So note that if we looked at it statistically, the S&P futures actually typically moves ahead of the S&P actual index. Excuse me. When that statistic was first realized, the initial reaction was that, well, that's the tail wagging the dog because it's a derivative market. People were missing the price discovery aspect of pricing that I'm talking about here. Which market moves first is likely a function of concentration of resources. Which market has the greatest amount of people, capital, and technology devoted to trading? And to use a specific example, rather than leave it completely abstract, consider the U.S. Treasury and related derivative markets. There are more than 300 different issues of regular T-bills, bonds, and notes. There are only 7 Treasury bond or note futures contracts. And oftentimes the notional volume of trading of futures is more than twice that of the par value of traded Treasury bills, bonds, and notes. Well, given that much smaller number of contracts, that allows for a much greater concentration of resources in Treasury futures. And as I said about the S&P futures versus the S&P actual index, Treasury futures oftentimes lead the Treasury market because of that greater concentration of resources. So what does that all imply about the way to interpret this formula? Well, given that both the futures price and the price of the related security or commodity are reacting to, the traders in those two markets are reacting to the same information, that means neither is the dependent or independent variable. They are interdependent variables. They're both responding to the same sorts of informational inputs. And whichever market moves first is, again, primarily a function of concentration of the resources I referenced previously. So the right way to think about this formula, or the one at the bottom, is not that you can automatically derive the value of one from the other. Oh yes, in an arbitrage pricing sense you can, and it depends on which market is reacting first. But the right way to think about the formulas is not that it is showing how to derive the value of one versus the other. What the formulas are really showing is how to derive the fair value of one relative to the other. So yes, given the price of the underlying, I can derive the fair value of the derivative. But given the price of the derivative, and oftentimes derivative market moves first, I can derive the fair value of the underlying. So if derivative contracts were given a name that was a descriptor, because realize the word derivative is just a name, it's not a descriptor, which all too often people try to interpret it as. If derivatives were given a name that was a descriptor, they would have been called relatives, because that's what those formulas specify. What's the fair value of one relative to the other? Now, as far as why we need derivative markets then, well, that goes back to some of the issues that were talked about previously. Derivative markets can be traded usually at much lower cost. They allow much greater access to leverage than trading the underlying assets. And oftentimes they're more liquid than the underlying assets, as well as having the tax efficiencies I identified previously. So just to recap the general idea, and this is true much more broadly, don't assume that the name that is carried by some financial instrument, or for that matter some financial concept, is a descriptor. It's a reflection of industry jargon, and I'll focus more on jargon in subsequent sessions. But the right way to think about a derivative is not that it derives its value from the underlying. It's simply an instrument that allows a certain number of potential advantages or efficiencies relative to trading the underlying security or commodity. And the purpose is quite different. Securities markets exist as a way of channeling wealth into real investment in a way that enhances economic efficiency. Derivative markets exist to allow us to share risks more optimally, so that those who are risk averse can hedge away their exposures in a very efficient fashion, and those who would like to use derivatives as an alternative to trading securities can create similar exposures in a much more capital efficient fashion. So since it's near the official ending time, I will wrap it up there. But I am open to questions. Should anyone have a question related to things said or left unsaid in this very brief introduction to derivatives. And I will hope that all participants and future viewers find the information in this presentation helpful in sorting out some of the characteristics of derivative contracts and what distinguishes them from securities or commodities trading. I see a question there, and I think my audio is not working because I'm not hearing any voice, but I've got a question. Does the long and short sense get settled out at the end of the market close every day? Well, it depends on what market you're talking about. In the case of futures markets and cleared swaps, every day there's what's known as a mark-to-market, where the value of all open positions will be adjusted for changes over the course of that trading session. And the mark-to-market is the quantification of the change in value. Settlement, daily settlement, reflects the movement of money to adjust for exactly the change in the value of such contracts. So that would be true for all futures, which by definition are exchange-traded third-party contracts. So there's a central clearing party that becomes the legal counterparty to all such contracts, as is true for over-the-counter cleared swaps. On the other hand, for bilateral contracts, there will be adjustments to collateral over time, but it's not done on a day-by-day basis and generally only occurs if there's a large enough move. So the contracts will specify how large of a move there would be before there would be an adjustment to collateral. But those rules are fairly complex, and I don't know that it's the appropriate place or time to try to provide greater detail on those issues.
Doug, it's Paul Siegel. Can you hear me?
Yeah, I can now, Paul.
Okay, great. Sorry before everyone. This is deep stuff. There's a lot of information here. It's going to be, you're going to be touching derivatives if you're in the technology or operations area a lot and in many different ways. So don't expect to have gathered everything. But if you have a question, please do ask it. Doug is probably the right source for you to get the answer. And also is most likely that you and your colleagues have the same questions. So you're not alone in that. And I found often when we do training, people are afraid to ask questions that the person next to them has the same exact question. So don't feel shy, particularly now also because you can text it. You don't have to even raise your hand. Again, we'll be covering more on these types of products and markets. Doug will be in particular in the next days ahead. Appreciate your time. There's no other questions now for the moment. Again, please do give us feedback. You'll see a link on the side on the right. It gives you access to one of Doug's courses as well, or other courses that we have online. And Doug, with that, I think we're set for the day. And everyone have a wonderful day and the rest of the week. And we will you will get access to this recording shortly. Thank you, everyone.
Very good. Be well, Paul.